Are you ready to invest in your financial future, but feeling a bit lost on where to start? It's crucial to establish your financial goals and prioritize them before diving in. All too often, people rush into financial decisions without taking the time to consider what truly matters to them. Caught up in the hustle and bustle of daily life, we disconnect from our deepest desires and fall victim to the pressure of conforming to what others tell us is important. This can lead to confusion, fear, and a sense of being disconnected from our true selves. Don't let a lifetime pass you by without living a life that truly resonates with you. Take the time to identify your goals, reconnect with your desires, and work towards them with intention and purpose. It's never too late to make a change and live the life you've always wanted. Before you start putting your money into the market, there are a few crucial steps you should take to ensure you're on solid financial footing. First things first, pay off any outstanding debts. Once that's taken care of, it's time to start building your emergency fund. Why? Well, life can be unpredictable and sometimes throws curveballs our way. Whether it's losing your job or a sudden change in your financial situation, having a safety net can mean the difference between weathering the storm and being left out in the cold. An emergency fund is essentially an investment in yourself and your future. It's a way to protect yourself during tough times and ensure that you're financially secure, even when things get rocky. Aim to have at least 3 to 6 months' worth of living expenses saved up in case of an emergency. But that's not all. It's also wise to consider purchasing insurance to safeguard your loved ones, assets, and yourself. Major medical health insurance, adequate liability insurance on your home and car, long-term disability insurance, life insurance, and estate planning are all important components to consider. If you're looking for a higher yield with the same safety profile as a bank account, a money market fund might be the perfect solution for you. A money market account functions just like a traditional savings account, but with one major difference. It typically offers a higher interest rate. Plus, you'll have the added convenience of check writing so you can use it as a substitute for your regular bank account. You might be wondering about the safety of investing in a money market fund. While they're not FDIC insured like a bank account, mutual fund companies are required to hold securities in their money market funds that are just as safe as the ones held by the U.S. government. In fact, money market funds are required to have $1 invested in securities for every dollar deposited, compared to banks that only need to have about 10 cents for every dollar. So when is a money market fund a good choice? It's an excellent option for building an emergency reserve, achieving short-term savings goals, parking money while you decide where to invest it, or even as a personal or business checking account. You can deposit checks, hold excess funds, and pay bills using the check writing feature. Don't let your enthusiasm for spending or investing in non-retirement accounts cost you tens of thousands to hundreds of thousands of dollars in the long term. Start a retirement account as early as possible. Retirement accounts offer you a tax advantage, but one common mistake young adults make is not taking advantage of them. While it's true that you can't access these accounts before age 59 and a half without incurring penalties, it's important to remember that a retirement account is a shell that keeps the government from taxing your investment earnings each year. So, start early and let time and compound interest work in your favor to secure your financial future.